as well as the economy, fiscal side, and the monetary side. Today, inevitably, we will be covering the mid-year review as articulated by the Honorable Minister of Finance late last week. And then we will look at one area that addresses investor implications in terms of the capital market and in particular the National Investment Fund. These are the two parts that we are going to be covering today: the economic and fiscal review and outlook firstly, and then the National Investment Fund as articulated by the Honorable Minister. So let's start with the economy, and we will spend in total about 30 minutes in terms of the review and then open it up for questions as we normally do at the back end. So let's talk a bit about the economy, its review, and make some commentary in terms of the outlook. The question that is being asked, and we want to take away some of the heat out of the discussions and focus on the light in terms of the discussion. Is the economy in recovery? Is the economy booming? And what is our take at Bourse on this? Well, we tried to get certain indicators of what is an economic recovery as opposed to indicators for an economic boom. Let's deal with the boom story first. In terms of a boom, we would want to look at output and income, employment, prices, profit, and essentially interest rates or the movement in interest rates. When we look at what has happened in terms of GDP in 2017 versus what's happening in 2018, GDP corresponding has been -1% in 2017, and it is estimated to be 2% in 2018. Unemployment is up from 3.9 to 5%. Prices measured by way of headline inflation is really down from 3.1% to 1.3%. Profits as measured by the profitability of those companies listed on the Trinidad and Tobago Stock Exchange, 16 out of the 26 listed companies reported lower earnings. And in terms of interest rates, there are no real price pressures and unlikely, in fact, that interest rates could trend upwards. On this basis, the economy is not really booming, but I would say in terms of a recovery for which we have coined by quoting Investopedia, the economic recovery being defined as the first year of positive growth following a recession. And if that is the case, then we are in economic recovery mode. Even though some analysts would have liked to see a more broad-based recovery, the fact is that we remain fairly a one-horse economy, fully dependent or primarily dependent on energy production and energy prices. So we are in recovery, and the answer to that is in fact yes. So let's look at the next slide and see what's happening as far as that is concerned. I'm trying to get the next slide up. Let's see what's going to happen with regard to that. Okay, so right. As to the question of economic recovery, we've already answered that we are in recovery mode and that in 2018 we are going to see, as estimated, a 2% growth in the economy. This is subsequent to 2016, which saw a decrease in the economy of 6% followed by the estimate for 2017, a negative position of 1%. When we look at some other areas that test the question of the recovery, I think it is important to focus on the economic growth drivers. As you will see on your screen, over the last 3 years or so, the energy sector would have contributed more than 75% out to 82% of the economy, whereas non-energy would in fact be contributing just about 20% up to about 22% as far as the economic growth drivers are concerned. This is important, and we need to look at what are the various contributors and what could likely happen in terms of the economic outlook because of the various contributors to the economy. Economic growth drivers, we look at the energy sector, and we'll show later what has been happening in terms of natural gas production. Let's start by saying, first of all, that our energy bucket is made up essentially of oil, which might be 10 to 15% of the energy bucket, depending on what time you look at it, what year, and 85 to 90% made up of gas. And the projected growth in terms of gas production we'll see in a little while. And also what we will look at is what are the new projects that are in the pipeline, what's going to happen going forward. Then of course we'll look, apart from volume, we will look at prices. So this particular graph shows you what has been happening with regard to natural gas production. And in the years 2016 and 17, as you would see here, these 2 years were the lowest production over the last 7 or 8 years, coming from about 4.1, 4.2, and driving downwards in 2015 down to 3.8 billion cubic feet per day. That has turned around. Based on the estimates for 2018, we see that production has increased considerably, and the projections are for production to continue to increase over the next couple of years. So, what can we make of this in terms of the economic outlook and in terms of economic recovery? We look first of all at oil production and prices. And when we go back as far back as 2010, what we see is the ongoing decline in volume production of oil. Barrels of oil started in 2010 at 98.2 thousand barrels per day, has continually trended downwards, so much so that in 2017, that figure volume is at or was at 71.9 and is now just a tad below the 70,000 barrels of oil per day in the January to March period, where it was down to 68.1. That's volume. What we have seen is the very difficult years of 2015, 2016. Oil prices dipped below $50 and has been increasing to a level on average of about $62 in the January to March period, and today it is about $70 or so. So that again is an important indicator of recovery of volume, also with the fortunate position of oil prices going on the upward trend. So that we move to our next graph, and we want to look at the composition of gas production, and we will look at the what are the main utilizers of gas production, volume and price. That would be LNG, that would be ammonia, and that would be methanol. LNG production and prices, if you look at the past 4 years, what happened in 2013 was production in terms of cubic meters in 2013. What you will see is that volume production has been falling, and it has been falling so much so that there was a 20 to 25 odd percent decline from the 2013 2014 figures, down from 32.2 to 24.4 or 25.75. So what we have also seen is that while this has been trending up very slightly, what we can expect is that with the increase in gas production, that to levels that would have obtained out in 2014 or thereabout, just a little bit below, we can expect some impact in terms of the economy going forward with regard to volume. And you can see as well on your screen that the average prices have been going up in terms of LNG prices. Good indicators for us. Let's turn now to another area. And let me say, if we think about the energy bucket, or shall we say the natural gas bucket, you can think of LNG consuming about half of that gas production, and you can think of petrochemical being about 25% of overall utilization of gas production. And of course, the rest, the remaining 20 to 25%, being for purposes of electricity and other general uses, and previously for steel, but much less so now. So we are seeing in terms of ammonia, we've spoken about LNG, and we are seeing in terms of ammonia what has been happening. So you are talking about 5.5 million tons in 2010 and down to 5.04 million tons in 2017. But prices, though, have, after peaking at well above 500, have fallen, as you would see on your screen. And so prices have come down to a low over the period, and up to 237 US dollars per ton on average in 2017. And currently in April, I should say, $225 per ton. Let's turn now to the next indicator, which is methanol. So we'll see here in terms of the methanol story what has been happening. If I can get this up on the screen, yes, it is up. And so what you see in terms of methanol is that concurrent with the gas strictures that took place, you see that methanol production in terms of 6 million tons and would have gradually decreased, and with a very difficult year in 2016 fallen significantly. What is important as well is that methanol prices would have come down from the 2014 period down in the 2016 to the low point in 2016, climbing back up in 2017 to an average price of about $399, and as at the end of April was in the order of $466. So these are the main contributors in terms of gas utilization. LNG about 50%, give or take. The petrochemicals, mainly methanol and ammonia, about 25%, and then other usages. So from this, we think in terms of what is the outlook if the economy is dependent so much on energy, as we have just shown, natural gas, what's the outlook? Well, we do have, shall we say, a ceiling in terms of gas output. When we look back, the high point was about 4.2 billion billion cubic feet. And it has gone down, as we said, to about in 2018 estimated to 3.8 and expected to go up. Now, the implication for this, as we think in terms of the medium term, is that apart from the Caribbean Gas Chemicals Limited, which is the Mitsubishi massive project for 1 million tons of methanol, there is no known project in the pipeline as yet for a capital project, shall we say, in the petrochemical sector. And this is because of molecules, that the output of gas or the capability to produce more gas is somewhat limited by the strictures of gas production, one, and reserves of Trinidad and Tobago. So we will hit that ceiling, and what we will essentially be doing is being able to take all of the various users up to capacity. But there is not much room for attracting, shall we say, new capital projects, which will essentially be looking for significant projects for 15 to 20 years of reserves in order to support these projects and the assurances and guarantees with regard to gas. That's one of the areas where, as we look out, there is that, shall we say, ceiling in terms of where we can get new projects going in the petrochemical sector. Let's look now, move from the energy sector and look towards the non-energy sector. What's happening in the non-energy sector? Well, what we can see from the screen before you is that the non-energy sector declined in 2016 by 3.1%, further declined by 2%. And if we are to interpret what the Honorable Minister has said in terms of the non-energy sector, he has said that the non-energy sector will be in balance, suggesting that we will more or less be zero growth in 2018, and the outlook for 2019 and 2020 is positive. Is there a recovery in the non-energy sector, as some have suggested? We look at what has happened, and we look at it from the point of view of what has been reported, is that revenue from assembly type industries increased by 146 million, and revenue from financial services sector increased by 153 million. Investors will recall that taxes would have been raised in the manufacturing sector generally from 25 to 30%, and in the financial services sector from 30 to 35%. That being the case, one can argue that these increases are more assist the fiscal side, but not necessarily provide any fillip in terms of additional production and output in the economy. So clarification is needed as to whether growth in the non-energy sector is due to growth in tax revenues, which is not economic growth, but it's really fiscal benefits to the government because of the tax take. There is another brewing argument or discussion that is going on in the industry by analysts, and that is the matter of reclassification of GDP industry groupings. That's a matter that we will have to speak about in a little while, and whether there is GDP growth, I think that is less likely. Let's look at the rebasing. In 2017, the reference base year for GDP was changed from 2000 to 2012. But more importantly, the classification and the composition of the manufacturing sector changed considerably. What you would see here is that prior to the change and the rebasing from 2000, the manufacturing constituted about 7.8% of GDP. Switch very quickly. If you look at this at the same year, you would see manufacturing now constituting 18.4% of GDP. And that really is now because of the inclusion in the classification of chemical and chemical products, which you see taking up that additional space, 13.1% of GDP. So the question about where has manufacturing gone, these figures might suggest something a little bit different, but the buttress to the figures would really be the inclusion of petroleum and petroleum chemical products in the classification of manufacturing. No real major change in manufacturing, more a reclassification. Let's now move to very quickly to the fiscal review and implications, because I want to get very quickly now to the National Investment Fund. When you look at what has happened in terms of fiscal revenue and the implications thereof, you see on your screen here the revised budgeted figures. So what has happened? The original budget, 45.74 in revenue, revised to 44.68, a decline in revenue of 2.3% from the original to the revised. Expenditure has been cut in terms of budgeted figures from 50 billion down to 48.8 billion, or a decline in expenditure by 3.2%. And we will look at how that has been cut in terms of, in particular, capital expenditure. The fiscal gap has been adjusted, therefore, from 4.75 billion to 4.2 billion, and the fiscal gap as a percentage of GDP has fallen. Questions as to where was the borrowing in the revised budget. It was originally intended to borrow 4.5. We don't know what that figure is, except to say that in the first half, that borrowing by central government was in the order of 2.6 billion. So we look now at the actual position as at the half year, and we can see that current revenue budgeted for the half year was exceeded 19.5 billion versus the budgeted 18.7. So there was positive change. Expenditure also was reduced and cut in many areas, transfers and subsidies, as well as capital expenditure and goods and services. So there is a cutback. It is causing some tightening in the economy because government expenditure, which is an important fillip to the economy, is not as high as expected. So we move now very quickly through this and look at the capital expenditure trend. So capital expenditure trend, what you are seeing is that in 2014, expenditure was $8.4 billion, down to a budgeted figure in 2018 of $4 billion. That is another important contributor to the economy, where the wind has been taken out of the sails, and it is not going to be a major contributor to economic growth because of the reduction in capital expenditure. We move now very quickly to other aspects. And I wanted to make mention of the fact that even though there is some constraint in terms of fiscal measures that can give a boost to the economy, and even though government remains pretty much tied to the maintenance of an official foreign exchange rate, even though the unofficial rate is about 20 to 25% higher, there is still room for monetary stimulus. And by that, I mean all of the conditions are right for giving a fillip or a boost on the monetary side by adjusting interest rates downwards. We have spoken about that in our webinar in the April 2018 presentation, and you can look to see why our view is that interest rate as a monetary measure should be cut. So now we turn in the next 10 minutes or so to have a conversation about the main capital item that the Honorable Minister spoke to in terms of the capital markets. And this is the institution and of the National Investment Fund and the disposal of some 49.9% of that company, or should I say the divestment to investors. So let's look at some of the parameters of the National Investment Fund. First, the estimated size of the fund will be somewhere in the vicinity of $8 to $10 billion based on valuations of two remaining factors, TGU, as well as one other player, which is Methanol Holdings International. And we'll come to that. So basically, what is being sought to fill the fiscal gap is $4 billion through the sale of assets held in this fund, or through the sale of units or shares held in this fund, which means that the divestment will be just under 50% of a $10 billion asset size. Let's look now at what that composition is. Well, from the information that we have gleaned at the mid-year review, this fund will be made up to the extent of some 43%, 42 million shares, comprising, or in value, $4.3 billion in Republic Financial Holdings. Angostura, 61 million shares, which is about close to $1 billion and constituting 10% of the fund. One Caribbean Media, 50 million shares, or some $189 million in value, 2% of the fund. Whitco, 402 million, constituting 4.5 million shares. And these are all listed companies, so that the valuations are pretty clear. In addition, you have Home Construction Limited being put into the pot, 19.5 million shares, with an estimated value of $476 million. In total, these will constitute some 64% of the fund, and without home construction, it will constitute some 59% of the fund. Now, when we look at this, what we are seeing is that there is a significant amount of overlap that is taking place with the National Investment Fund, meaning that some 60%, 59% of the fund is already traded. What is the investor going to get incrementally by buying into the fund? Well, the investor is going to get incrementally exposure to Home Construction Limited, exposure to Methanol Holding, if that purchase is actually realized by the government, and exposure to Trinidad Generation Unlimited, which is the electricity generation company. And the question that is being asked and will have to be addressed is, why is it that there is so much overlap? For example, if you as an investor can purchase Republic directly, or you can purchase Republic via the CLICO Investment Fund, of which 85% of that fund is Republic. This is just another layer of overlapping that may not produce the kind of benefits for the investor. So it's all up then to TGU, MHIL, and Home Construction, which investors would not have had access to up until this point in time. So we turn now and we look to see what's happening. We have asked the question, what is the nature of the fund? Will it be a mutual fund, or will it be a holding company? It seems to be heading towards a holding company. There has been some conversation about making the fund attractive, and the question is, to make it attractive, what may be the discount in terms of the price as against the valuation? Well, let's look at two funds that are traded. First, you have the UTC Macro Index Fund, which is trading at a discount to the net asset value of about some 20%, as you would see here. And also the Clico Investment Fund, which is trading at a discount of about 13%. Other funds that have been on the market, the Praetorian Fund, has traded as low as 31% of its net asset value. So where and how is the fund going to be structured to make it attractive relative to its net asset value and to attract the investor? The other matter that we should look at is the amount that is needed to be raised in order to close the fiscal gap. And that amount is in the order of $4 billion, constituting 49% of the fund. And what would be the sort of yield that would be necessary? And we go now to look at what's happening in our market. And when you look at our market yields, dividend yields are pretty high in the case of other institutions that are traded from 4.3% up to 5.6%. The index is at a yield of 3.1%. What will be needed to do that? I'm going to talk now about the question of the size of the divestment, which is $4 billion or 49.9% of this NIF company. And when you look at it, let's look at what has happened with regard to prior divestments. So you look at some of the state IPOs and APOs, and if you look at it from the context of timelines, the first Citizens IPO, the subscription was $3.3 billion and allocation was 1.07. TTNGL, its IPO, subscription was 2.6, applications 2.6 million and allocated 1.2. When you go now to the first Citizens APO, additional public offering, what you see is that while the issue size was 1.55 million, subscribed was just about $1 billion or just about 2/3. And this asks the question, if an issue turns out to be not as attractive to the investor, what will be the take-up? You will see here, next in the timeline is TTNGL APO, and the applications were high, 1.3 billion in total, but what was available for issue was 85. So here's where we are, what we are talking about in NIF now, 4 billion. And the question is, does the market have the absorptive capacity from the private sector as well as the state sector to take up this 4 billion to fill in the gap that is required to close the fiscal position, or to balance the fiscal position, if you want to put it that way? There are questions as to what is the likely outcome with regard to that. As we get more information, we will be able to flesh out some of these discussions with regard to the NIF. Let me close now with some conclusions. Recovery in natural gas is a very much required situation, and it is coming to pass, and it will help and flow into the economy and give the impetus for some recovery. Yet still, there are no real new projects that we see coming on stream. So we're not going to get beyond what our high water mark was in 2014 or 2015 or thereabouts, until and unless we can find new projects, and probably those projects will have to come from making better utilization of our gas as we go along. There is a pickup in the energy sector. There is need to extract more value from the energy sector. There are new technologies available that can take us down to further levels of derivatives beyond methanol, beyond ammonia, and so on. Diversification is needed. Let us look towards diversification from within the energy sector with these new technologies that can add value, as it is unlikely that the non-energy sector can give a significant fillip in the short to medium term. So let us now close on that basis and take questions from participants. First question, which is coming up on the screen. What might be a good discount for the NAV for the National Investment Fund? B, what would be a good discount? Well, I think when you look at historically what has been happening, I think to make the NIF attractive, especially at the much higher level of divestment at 4 billion, then we ought to be thinking somewhere in the region of about 15%. Because if it is not sufficiently attractive, you might not get the kind of take-up that you want. And also, if it is not sufficiently attractive, the question of who is getting value, if the state sector is prodded to invest more in the fund, will they be getting value? So I would say in the vicinity of about 15%. Second question that's up on the screen, what might be a good dividend yield for NIF? Well, there are two aspects that we will have to address. The first is, will the price of the NIF hold post divestment? And if we take it from the point of view that you can get a price that will hold or go up, then a good dividend should be somewhere north of 3.5%. I would suggest that when you look at TTNGL, which started at about 6% and is down now to the mid 5%, then you see a marker in terms of what may constitute attractiveness to the investor. Where did the projection from natural gas come from? Well, I think this is an agglomeration of the contributions of the various upstreamers. I don't know where the projections would have come from beyond 2019 and so on, but I think it is a reasonable position based on the estimates once they come to fruition of the various projects that are on stream, upstream. What is the level of liquidity available to invest in NIF as per official figures? Well, we have shown before that the figure for liquidity, surplus liquidity, could be in the order of upwards of $3 billion. But it's not necessary that that liquidity can or will all go to investment in NIF. But further than that, the reserves that we have are relatively high, above 17%. In fact, with hidden reserves, some bankers say it could be about 25 to 27%. So if needed, you can drop the reserves to meet liquidity needs. So there is a tremendous amount of liquidity, 3 billion, and then the ability to adjust the reserves to further provide liquidity to the system. Next question up on my screen. What would occur if the 4 billion is not raised by the NIF? Well, clearly, to make up the gap, you will either have to cut expenditure or you will have to turn to borrowing. And if you turn to borrowing, the expectation that debt to GDP will be in the order of 55% as reported in the mid-year report may not be realized, because you will have to borrow more to make up the gap if expenditure is maintained at the budgeted level. I think that's about it for our questions. If you have any further questions, please send them to us at Bourse, and we will seek to address those questions for you as we go along. There's just one more question, and I will take one more question before we go. Trying to get that question up. So I can't seem to get that question up. Let's see what it's saying there. What if the investor currently not exposed to these investments? How attractive will how attractive will the NIF be to such investors? Again, it is about what is the discount. If somebody is not invested in any of these listed investments, it may be more attractive than if they already are invested to remove much of the overlapping. That's it now for our May webinar. We invite you to send any further questions that you have, and we invite you to look at this webinar, the presentations, by clicking on our website, because I think we have run through it fairly quickly, and you might now have better chance to digest and ask any further questions that you may want to. That's it from us at this Bourse May webinar. Have yourself a wonderful day and a wonderful week, and great investment as you go along. This is Subhas Ramkhelawan for Bourse.